Now we're going to turn to U.S. GDP. A lot of these movements in terms of, some of the pricing that we talked about, what does GDP look like? What is consumer spending, income? Some of this is going to be a little bit of a look back, but we're going to try to take what we've seen in Q1 and again, project it forward. So first is we want to talk about that overnight reverse repo. I did a whole thread on it. We've talked about it ad nauseum in last week. So I don't want to go too much in depth, but I thought this was an interesting chart from Wall Street looking at Fed's overnight reverse repos, because most of these, or I should say all of these, happen at either year end or quarter end. And that we hit a peak at May 27th, which is closer to the end of the month, but May isn't the end of a quarter. Why wasn't this happening in June? And that's why we start to see some of this friction in terms of what is available, what is the what comes next type thing with liquidity, with easing, tapering. And that's why I think the tapering components are going to continue to become more and more important when we look at what is happening over time. And this is where we go to, well, what has happened since May 27th? And here you can see that we've maintained this elevated level. Now, it's come back from previous highs from the end of 2015, from the end of 2016, but it's still at all-time highs in comparison to all the quarter ends, and we just continue to see a lot of individuals involved in doing something with this spare liquidity. Because you can either structure it as an overnight purchase or as a term purchase, which is typically anything within a span of 366 days. So this temporarily removes your excess liquidity, but again, it's only temporary because it does come back. And that's where this is just a short-term solution to a long-term problem. And normally when we get to these levels, it indicates that the Fed is going to have to get more serious about tapering. Whether that happens is neither here nor there. Like, if you look at commentary from recent Fed governors, they're like, well, at these levels, we're going to have to get serious about thinking about, talking about the possibility of potentially easing or reversing, our easing stance. It's like, what? Like, I don't even understand what you're trying to say. So you're going to thinking about tightening, but when? Like, what do you need to see when you look at, the stock market at all-time highs, globally, when you look at commodity prices through the roof, inflation, at your own admission, some of the, the ways that you look at it at well over 4%, at what point? And then, $15 trillion later, and we still have how many people unemployed? So at what point do you just have to say, look, what we're doing is too much, or what we're doing just is no longer effective because the law of diminishing returns is real and you can't just keep throwing zeros at it? And again, these are those conversations that we keep having, but that's why when we turn to core PCE. So when we look at this is a key metric that the Fed talks about. We talk about the Gdp Price Deflator, then we look at core PCE. So the Fed objective is 2%, and as they've said previously, they would tolerate above 2% for an extended period of time. But they never classified or clarified how far above. And that's when we look at the core PCE at 3.1%. And just as we've talked about with all of those components that we keep seeing, making up the CPI number, making up the supply chain, this is not coming down anytime soon. So then they say, well, it's transitory. But what is transitory? When you go back to the 1940s, after World War II, it was transitory, but it lasted 2.5 years. So is that transitory? Like, for me, when you think about something like that, that is not transitory. That is a part of a cycle. That, okay, well, transitory in my mind is, a day, a week, maybe a month or two, maybe a quarter, but 2 years. I mean, some of these things become ridiculous, which is why I think the conversation on tightening monetary policy is going to have to accelerate when you start layering in all of these problems that continue to arise in the supply chain as well as in the underlying metrics that we look at. And what are some of the core PCE drivers? So when we look at this is where that stagflation conversation starts, because core PC prices increased by 0.7% in April, with annual core PC inflation rate up to 3.1%, a multi-decade high, while real consumption fell by 0.1% in April. So you have consumption dropping as prices are going up. And that's when you start talking about, okay, well, is consumption dropping because people are starting to reject pricing? And that's going to mean that prices can't really go much higher. Now, there is potential with that, but as we talked about with the drop in inventories, you're still going to have to buy. You may not buy as much as you would if prices were better, but you're still going to have to come to market. You're still going to have to buy something, and that's where we see some of this friction. Now, we've talked about prices in May. Prices in May have continued to go higher, so we still expect a month-over-month increase. But then when we start looking in June, based on what we've seen, some of those components have started to flatline, especially commodities, but they're going to be replaced by housing. So that's why even in June, you're going to get that next shift up. So we really won't start to see any sort of real normalization, or I should say, this flatlining until we get into July, or the potential for July. So used light trucks, and trucks and cars in general is still going to see another increase. Personal computers, anyone who's tried to buy a phone, a computer, the wait times, the costs, all of those incentives have now gone. So that's going up again. But then housing and healthcare. And I think the housing side is the one that is going to continue to see that drift higher. Car rentals are continuing. They've only gotten worse in May and June. Transport, air transport, same thing. So a lot of these pieces are going to see that next shift higher. So then the question comes down to, what does the Fed consider as transitory? Which is where we look at personal income. So personal income, now that you had that big stimulus boost, personal income, a surprise to the downside at 13.1. Personal consumption expenditures, again, in nominal dollars, was at 0.5, coming down. But the more important one, that core consumption was back into the negative territory, because as we said when the stimulus came out, a lot of that was pulled forward when you looked at credit card data. So a lot of that pulled forward, and now you're starting to see some of that dump back in. And now, as we go into May and then into June, you're going to see some of this stabilize. But as we also talked about in March and April, a lot of that reopening pent-up demand was there. It happened. And now you're going to start to see a bit more of a normalization, again, higher than 2020. So to be clear, I am not saying we go back to the doldrums of peak COVID lockdowns. I'm just saying that we're going to normalize at a lower level, because we continue to see some of this continuous pressure in the system that is building up based on pricing, inflation, weak pricing, low jobs, inability to get higher wages, which again, that wage compression is just going to become that stickiness to, well, where can U.S. consumption really shake out? Which is when we start looking at wholesale inventories that have continued to drift lower. So wholesale inventories total monthly change, and this is just talking about change. So it's a positive, but again, it's still at a very depressed level. And that's why they just can't catch up, which is when we look at the inventories on a seasonally adjusted level, they're negative. So typically, and this is what we always talk about, you normally gear up for summer, because summer is a seasonally, people feel good. They're taking vacations. They're with their families. You're going to spend more on your family on vacation versus, sitting at home. You'll splurge on the bigger dinner, on buying your kids, some treats or gifts, something along. And now you're just not getting to that level. And based on where we are for inventories, to get back, again, that inventory side, you're going to be subject to price, and those prices are going back up, which again leads to some of that additional friction in terms of what can the consumer really purchase. So then when we look at U.S. goods trade balance, this is where you continue to see, it's gotten a little bit better, but we're still importing a lot, which is why when we talk about importing inflation, we're beholden to the global market. We've exported our inflation, we've imported deflation, and now you're starting to see us come essentially full circle, and this is now biting us in the butt in terms of where we are on the current cyclical nature, which is why real personal consumption expenditures are still below the trend that we were pre-COVID. And the one thing that we look at here is the rate of change. And that's why when we looked at what happened from January, as we were saying, when we expected to see this big bounce off of that low, where we're going to get this big surge in hiring, we're going to get a lot of activity because people were gearing up for the reopening trade, and now it's happened. And now you look at the rate of change here, it's actually starting to flatline and come down a bit, which is, again, leading to where is that consumption expenditure going to really be, especially when you consider that we're coming to a strong period. We should see an increase in consumption, and we continue to see some of this struggle to get back to some of that normalcy, which is when you turn to housing, as we talked about a lot of these housing costs. So when you look at new home demand, again, it remains high, but as we said last week in our real estate section, you're starting to see some of that slow, where under construction, home builders are like, look, we're going to delay taking new orders, and we're going to try to catch up with where the demand is. I've pre-sold 12 homes, haven't started construction. Let's take, because of the supply chain shortages, the delay in lead times, let's take what we have and start these projects. And that's where you're starting to see some of these slowdowns. It's clearly still high, not saying it isn't, but we're starting to see some of those peaks and some of those coming down in terms of what's under construction, not started, where we expect the not started to continue to increase and under construction to kind of flatline here as you see some of those flip on the over the next few months. But second home and investor properties continues to go higher because people have excess cash at that top percentile and they're looking to invest. And based on what we've seen over the last 20 years, what is better than real estate? I mean, we had a huge, the great financial crisis, and home prices have not only just outpaced that, but they've taken out those highs, and you're continuing to see a lot of this come back through, where second home and investor properties as a percent of mortgage applications continues to shift higher. You see a lot of some refinance coming back up as rates still remain low, not quite obviously where they were at peak COVID, but again still at a depressed level. But then when we start looking at the Main Street side, so when we look at home base, so as of April 17th, employees working was up 10.3%. As of May 17th, employees working were at 12.6%. So we're starting to get some of that back on the home base side, and this is where that competition is going to be, because we're starting to see some of this at the smaller entity, and especially when you look at that seasonal hiring, where this is kind of that seasonal bump that we would expect, but we're not seeing it at the manufacturing side, where we're actually seeing the opposite. So some of the services are getting better, which again has been the biggest driver and will continue to be the biggest driver. But on the manufacturing side, that was the first surge, and now we're seeing that big pullback, which again is kind of creating that friction point in general. So then when we turn to U.S. personal consumption, again, this is looking at month over month. So personal consumption expenditures, we're up 0.6. U.S. personal consumption was up 3.6 over time. Expenditures, that core price at 0.66, and then U.S. personal consumption expenditure core price at 3.066. So this is again showing the price increases, which is where we start looking at that inflation, those deflator sides. So this is just showing the additional, the personal consumption expenditures. How much are you paying for consumption? And that's where when we turn to stimulus in general, which is why we were saying in 2020, when we were in a pretty strong deflationary cycle, that dollar went much further. Now that's not going to the same level. You're not getting the same amount for your money, which again is creating that weight on just that expenditure and how much you're willing to spend, because now you're unsure about taxes. What is stimulus doing? What do I do with these numbers? And that's why I think you're seeing some hesitancy come into the consumption side, into the consumer side, as they try to figure out, what comes next and how much do I need in savings. And that's when we start looking at that GDP price index at 4.3% quarter over quarter, personal consumption core price at 2.5 quarter over quarter. You're seeing, again, that pressure to the upside, which is just reverberating through the system, keeping, the consumer hindered in terms of what is the next leg up, which obviously if you look at anything in the market right now is completely ignored when you look at meme stocks and just things that happen in general. But again, these are problems that continue to reverberate in the system. Then when you look at U.S. credit and debit card spending, you can see that it's obviously changed based on income levels, where you saw that big spike ahead of stimulus, and now it's come off fairly hard. It's still up from January 2020, but it should be. When you think about, you had this big lag, you do have some pent up savings, you do have some pent up buying. It's just not what the market thinks it is, which is why you've seen a fairly strong drop, especially at the lower end of the spending patterns from 100,000 down, because those are people that just don't have the same salaries, and you're already starting to see that actually come negative again at the lower end, and then coming back down in terms of these, pressure on growth rates. And then when we look at the counterparts right now, the fixed rate reverse repo came in at $438.8 billion. Again, still maintaining these epic high levels, which just shows just how saturated the market really is with liquidity. So now when we look at the overall price index, again, looking at this in general, keeping in mind the credit card data, this is why some rejection is happening in the market. We're still at positive growth, but you're going to start to see the consumer, really take a breather, and that's where we start turning into GDP growth. So the annual trend is at 0.4% year over year, and the shortfall relative to pre-COVID is at 0.9%. So quarter over quarter annualized, you can kind of see where we sit overall at that 0.4. Now year over year, the expectation is that we're going to be at that 13.8. I continue to think that the inflationary impacts are going to become a bigger hindrance to overall consumption that is just ignored in the market in general. So then when we look at gross domestic product, just in terms of where we sit right now, so when we look at 2021 quarter, Q1, we came in at 6.4%. But then when we look at what made that up, so here you can see consumer spending, again, very strong. You had a lot of stimulus coming through, durables and non-durables. Now we're going to see durables and non-durables come down a bit, and services are going to pick back up, and you're going to see a little bit of that flip. The question will be, is it enough to maintain growth? Because year over year, durables was up 27.5% and services were down 3.3%. So it'll still be growth, but it's just going to be how much of that reversal happens, while non-residential investment on the structure side is going to remain weak, but equipment and IP continue to go up. And again, that's where we look at jobs. How much are you investing in IP and equipment, and how much of that is replacing hiring? How much of that is replacing the new jobs, which is where we continue to see some of this pressure points where exports are not really doing all that much. But then when you look at government spending, non-defense, which is those transitions, were up 44.9%. That will normalize as we go through. And again, when we look at how a lot of this was spent the moment it was received, or really was spent even ahead of receiving the check because you knew it was coming, that's where we think some of that slowdown comes through. And then the G and the C side really come down together, which again puts some of that weight on next GDP levels. And this is just looking at the pre-COVID side. When we look at, on the quarter, GDP was at 1.6%. And again, going through the same, demographics, when you look at just that quarter level where federal non-defense was up 9.7%, that's going to come back down because the stimulus is gone. But when you look at, again, on the non-residential in terms of fixed investment, equipment and IP still remain elevated, still well above pre-COVID, because a lot of companies won't be bringing back these individuals, which again is going to keep that job side very elevated. So then when we turn to government investment, has been running well below trend since, and this is looking at that investment on infrastructure, which is why personally, the last stimulus package, I don't really find all that necessary, where a lot of that should have been negotiated into the infrastructure deals, because there still remains a lot that needs to be done on what is our fixed infrastructure. But again, these are reasons why the bill is necessary. And for those that think it's going to be spent, instantaneously, it's not. It's over the course or a period of years. But we do need real investment in our roads, bridges, and rail, airports, because we need to get back to growth. And that's going to pay multipliers and dividends in terms of seeing that activity come back. Because if you aren't worried about potholes or going slow, or you speed through, or you have your pace of deliveries can accelerate, then delivery times get shorter. You see a lot of efficiency gains. Some of these things become very important when you're considering the investment or the payback period for the investment, which is why when we look at modernizing roadways, veteran hospitals, among most popular investments in Biden's infrastructure plan, I don't think anybody should be shocked, because this is going to go across party lines, where modernizing highways, roads, and streets, strongly support and somewhat support. You can clearly see that this needs to happen, and I think that if this goes across bipartisan lines, the question is going to be plug orphaned oil wells, electrify the transportation sector. Again, those are things that are nice to have. But why are we talking about this right now? I for anyone who's driven in New York or within the 95 corridor can appreciate how bad our roads are. So let's fix what needs to be fixed, and then we'll talk about how do we incentivize some of this EV adoption. But let's just fix the problem at hand that we can all agree upon. Get it passed. We know it's going to yield huge dividends. All we have to do is look at when Eisenhower installed the highway system and just what that meant for economic growth. When we just look at not only just jobs, but the ease of commuting, the ease of moving goods, that traction was felt quickly and across the broad swaths of the economy. And that's when we start looking at things a little bit differently. So let's look at personal consumption expenditures, excluding food and energy, are actually fairly high. Now, this is why I think some of this rolls, because you've seen, again, that reopening trade where people went out and bought, and now you're going to start to see that, to get tampered down, because you had that strong spike, that fade into January, nice little recovery, that last push as people got vaccinated, that pent-up demand, and now we think that there's going to be pressure to the downside, which again is going to weigh on some of the estimates in the market. That I think is where there's that disconnect between what the market is expecting and kind of what the data is saying at this point. And now we're going to turn to Europe and look at how things are really happening within the European theater.